Alright guys, in this video we are going to learn something really important. Now if you have been following our channel, you have seen probably our portfolio, and during our all portfolio update video we keep on mentioning something that we invest in great companies. And now how do we measure great companies? Great companies is not the company which has been surviving for quite long time. The idea and the definition of the great business has been laid out by Warren Buffett. What he says is a business that earns higher return than the cost of the capital is considered to be a good business. Now, if a company can continue to earn a good return for a longer amount of time, that is a hallmark of a good business. Now, in this, one important factor that comes is how the company increase the profit over the long term. So the one way of increasing the profit is you invest more and more money into the business, and whatever new and new money that you are investing back in the business, that is helping you to increase the profit. Now, let us try to take a very oversimplified example. Let's say you have a business and you started the business with 100 rupees. Now, next year, let's say you have got 20 rupees as a profit. That means you have employed total 100 rupees in the business, and next year you are going to get 20 rupees profit. That means simply you are having 20% of your return on capital employed, right? You have employed 100 rupees and you are getting return 20 rupees. That means your return on capital employed is 20%. Now, when you're getting 20 rupees as a profit next year, now you have something to decide. What to decide? What to do with this 20 rupees? You can use it in a multiple ways. Let's say you can take this 20 rupees for your own benefit, for your own interest, whatever that you want to do. That, let's say, let's call it a dividend, right? So that money would be taken, a portion of the money that has been taken out of the business, that is called dividend. Now, let's say out of 100 rupees, some out of 20 rupees, some amount of money could be dividend, and let's say 10 rupees is dividend. After you take 10 rupees as a dividend, or you can take this 20 rupees out of the 10 rupees out of the business, you are still having 10 rupees as your profit that you have earned in next year. What you are going to do with this 10 rupees? You can keep this in the business, so your cash balance that you had will increase, but it will not be fruitful, because the cash in the bank, it doesn't earn high return, right? So to utilize the cash, what is typically done, we reinvest this 10 rupees back in the business. To do what? We do this investment back in the business to set up probably new shop, or probably new plant and factory to produce more and more product, which will be bringing more and more profit. So the extra amount of cash that I'm putting back in the business, that should help me to get or to generate more profit. Now, what is the efficiency of this incremental capital? I hope it is clear to you what is your incremental capital. Now, once you understand what is your incremental capital, you have to understand what is the efficiency of this incremental capital also. Like, whatever return that you are getting on this incremental capital. There comes the idea of the return on incremental capital investment. Return on incremental capital investment, or in short, we'll call it ROIIC. So if your business, so let's take the same example, you had 20% ROCE because you have invested 100 rupees. Next year you got 20 rupees of profit. Out of this 20 rupees, let's say you have taken 10 rupees out of the business. That means, let's say that is a dividend. Dividend is half of the money. That means 10 rupees, you are taking it out of this. You had 20 rupees, so 10 divided by 20 is 50% you have taken out of the business. That is your 50% of dividend. And let's say another 50%, which is another 10 rupees, you are investing back in the business. Now, this 10 rupees, how much profit it is going to generate after that? This year you are having 20 rupees, but next year, how much profit you are going to get? Let's say next year your profit increases by 2 rupees. That means your next year, after you put this investment, the following year, your return is 22 rupees. This year you had 20 rupees profit, and next year you had 22 rupees profit. So because of this 10 rupees of incremental capital investment, extra 2 rupees has been earned. So this 2 rupees has been earned by extra 10 rupees that has been reinvested back in the business. So 2 divided by 10 is again 20%. If the return would not be 22, let's say if the return were, let's say 21, that means this year, without the capital investment, reinvestment, your initial profit was 20, but the following year after you have made the capital investment, it is 21. So that the change, the delta in the profit is 1 rupee. So this 1 rupees you're getting from 10 rupees that you have put back in the business. So 1 divided by 10 is equal to your 10 percentage. So in this case, your return on incremental capital investment is 10 percentage. So whenever you are making any capital investment, you have to make sure that the amount of money that you are investing back in the business, it is going to match the return with its original business. If let's say in this case, if you are taking example, 20 percentage was your initial return on the business. After you made the investment, it has now given, let's say, 10 percentage. So whatever original business was giving, it has given a little bit lower than that, 10 percentage. So ideally, we want your ROIC at least more than 15%. So if your ROIC is more than 15%, the amount of money that you have put back in the business, it is justified that you have put this more money in the business, and that is bringing out more and more return in the business. So it is improving, reinforcing your business profit. So I hope it is a bit clear now what is basic funda of this business, and how you are doing the basic math of your return on incremental capital investment. Now, when we will do this calculation, we will be able to get much better clarity. Now we will do this calculation. So now this is a very simple process. So I am going to show you step by step what you can do. For this, we are going to use screener. I think most of you who are being in fundamental investor who check fundamental, you're familiar with the screener. For this, we will use the free version only. That is a paid version of that of screener. We will not use it. We will check just the simple version of that. We have already had an account, so we just simply log into that. After we do that, any company that you want to check, we are going to check for multiple companies. So if you are not understanding one, no need to worry. When we calculate the same ratio for multiple business, I hope the concept will be very, very clear to you. So let's start doing the calculation. First, we will do this calculation for Asian Paint. Okay, so after you open up the screener, here you can click and search the company that you are looking for. So here is, you can search the search of a company. You can search Asian Paint or Pidilite, whatever that you want to search. So let's say in this case we have searched Asian Paint, and after we do that, you will find an option here, export to Excel. Now before we go to export to Excel, let us try to also understand some of the basic thing from screener. So from when you are opening up the company, you are going to get some basic statistics here. So if you are not finding anything that you are seeing here in your own home screen, you can do edit using this edit ratio. You can see here, if you click it, whichever ratio that you want, probably let's say your return on capital employed is not there, you can simply write return on capital employed. If you take it and if you just put a tick mark, that should come here. So now this is your ROC. So this is the business, its own business, how much return Asian Paint is earning at the current year. So this is what it means. Now you are going to check just not only this year ROC, you need to check what is the historical trend of ROC of this particular company, whether it's going up or whether it's going down. So it is going to give you some very basic idea about which direction the business is heading. So now let us try to see your ROC, what is the historical trend for that. So if we scroll down here, you will be able to see here on the ratio part, you are going to see ROC data is being available from 2011 and until the last year. Now, if you see, this is 30 for the last year. Now, if you are doing the calculation here, the value that you're showing is around 30%. So currently, the return on capital employed for Asian Paint is around 30%. That value, you can also see it from here also. Right now, if you see trend of ROC over the time 2011, it was around 59%, and as the time progressed, we have seen that the ROC is there in the downgrade trend. So the return on capital on this company is reducing over time. This is the basic judgment that you can make from here. Now check what is your cash flow here. Now this cash flow information you're going to find under this heading. Now this is the amount of your operating activities cash. That is, this is the real cash the company is earning by selling the paints or whatever service that it is providing. This is the real amount of cash. You can see different number in the profit, but that may not be the actual profit, because profit that the company is reporting, it is future based. This cash from operating activity, it indicates how much cash the company has actually received in that particular year, right? So this is your cash from operating activity. And if you want to see what is the capex that the company has done, so that to understand that, you have to come to the next part, which is cash from investing activity. So if you just click here and expand that, the first item that you see, fixed asset purchased, this is the amount of capex the company has done. Now, whatever capex the company is doing, it's basically bringing out, setting up new and new asset, right? The plant and land, all those things are considered to be asset. Now, in this, your capital, the fixed asset purchase is your capital expenditure number. So here, if we subtract the capex number from operating activity, we will find out the free cash flow of this company. Many of you ask this question, how to calculate what is the free cash flow of different companies. This is how you can do it. It's very simple thing to do. Come scroll down, get the cash flow statement. In there, for example, if we just take 2022, we will open up the calculator and we'll do this calculation. So in the year of 2022, the total cash that has come into the company's account is 986, and the capital investment that it has done is 538. So minus 538. So the free cash flow of this company at the year of 2022 was 448. I hope it is very, very clear how to calculate what is the free cash flow, right? So now let's summarize what all things that we have learned. We have learned how to check ROCE and what is the directional trend of ROCE as the time progress, right? So these two we have already checked. Now we will try to calculate what is your ROIC, what is return on incremental capital employed. So to do that, we will export this here. If we click it, we should be able to get all the important data that we need to calculate your ROIC. Now, after you open it, you have to do the enable edit. So after you do that, we will be able to see what all things that you see here. This things has been exported here in Excel so that you can make much finer calculation that you want. So to do that, we will first go to the balance sheet, right? After you come to the balance sheet, first we will do the calculation. What is the capital employed of this company, and how to find out this? To do this, we are going to add the equity share capital of 2013. The year is very important. We are going to do the same addition or subtraction for the same year. So we have added equity share capital plus the reserve plus borrowing minus whatever cash the company is having in their current or savings account. We have to deduct that. How to do it? We will go to the data sheet and we have to come to the same year, right? The same year is 2013. In this year, we have to find out what is your cash and bank equivalent. So this is the number, right? So if we subtract it, we are going to get the capital employed of Asian Paint at the year of 2013. So from here, if I expand that, I am going to get the capital employed for Asian Paint in all these years, right? So this is, I hope this is clear. The next item that you have to, it is not that you have to calculate, but we have to bring this information, which is PAT, or we can say profit after tax. If you're not understanding this calculation, do not worry. We are going to do the same calculation for one more company. It will be very, very clear to you. So now let us try to find out what is your profit after tax. To find out the profit after tax, we will go to the data sheet and we will come here. So in profit and loss statement, we will come to the net profit here. That is for 2013. So this is the profit. So we will bring all those profit. It was there in the data sheet. So we are putting it back in this sheet. Now, after we do this two information we need to do your calculation. After we have accumulated what is your capital employed and what is your profit after tax, then we will calculate ROIC. So now let us see how we can do it. So when we are doing your ROIC calculations, let us see how we can do it. So we are going to do this calculation for 2022. So when we are doing it, we have to check what is the incremental profit that you have in these 2 years, and then you have to divide it by the capital that has been invested. Now, when you're taking the capital, this profit was earned based on this capital minus this profit was earned by this capital, right? So by this, so this is yearly basis. If you're doing ROIC calculation, you are going to get 4%. Now, if you do this until this, you should be able to calculate ROIC for 2016. Now, you will not be able to calculate the same number for this 2 years because the data are not available. For data for this, you need to, when you're calculating your ROIC, you need this 2 years of profit and capital employed for this year and the preceding year. Since you do not have, we will not be able to calculate this one. So now this is on the yearly basis. You can do this calculation, right? You can see how the ROIC value is changing. Now your ROIC value is changing from 39%, then you have 13%, 11%, 10%, 30%, 360%. You can see this number is not very consistent like your ROC. You have seen the clear trend which shows that ROC is in the declining trend, but ROIC, you see it's going ups and downs. What is the reason? Let us try to understand. So what happens? Let's say you are investing some money in this business. It may not give you immediate return next year because what happens to set up the plant? You may need to acquire land, then you have to take certain approvals because it's a chemical plant. Then the full plant has to be developed, then it should be commissioned. So to do all those things, it takes time. So whatever money that you're putting, let's say this year, it may not be reflected in the profit just next year. It will have a lag. This lag, so if you're doing it in a yearly basis, you will see there are a lot of variation that will come. Now this variation will come and it will give you a lot of noise. So any ROIC calculation that you are doing, you should have a good understanding of the business. Like after it makes the investment, what is the typical duration the company can get the capacity utilization. So based on that, you should be able to take how many years you're going to take. Now ROC, this is yearly basis, right? So that you have seen, this is yearly basis, but you can do this on rolling basis also. Rolling basis, let's say you want to do it for 3 years. So what you can do for 3 years, you can take average and can check on the rolling basis. So this 3 years I have taken it, and from there, if I just do it from here, you can see this number. This is how it looks like. So by looking at it last 2 years, you see 3 year rolling basis, the return has improved significantly. That we can see. So probably these are the times, the investment has been done and the fructification of these things has been probably obtained after this time. So this is on the rolling basis. Now, depending on the business, you may do the same calculation for 5 years. 2 years, it depends on the business that you're dealing with. There's another way you can do the calculation for ROIC that has also been very popular. So now let us try to understand what is the basis of that. Just check this number. In the beginning of 2013, around 2,898 crores of capital was invested in this business. Moving forward, today it is around 14,534. So obviously the capital base has increased, right? Now let us calculate how much it has increased. So I'm going to calculate what is the change in capital, right? So how to do it? This is today's capital, and 10 years back, my capital was in that business is like this amount, right? Now let us calculate. So this is your change in capital. Now here, let's calculate what is change in profit. Let me put it here so that you can understand it much better. Yes. So this is your, whatever number that you see, this is your change in capital. Now I'm going to calculate what is the change in profit today and 2013. So this is today's profit. If you do the subtraction from here, this is the profit you had before. So you can see the change in profit, you have this. So you can understand that to bring this much amount of profit, you had put this much incremental capital back in the business. Now, if you want to calculate what is the end to end point, you want to calculate what is your ROIC end to end point from 2013 to 2022. So how I'm going to do it? Let's do the calculation. So this is end basis. So if I want to do this end basis calculation, so what I will do, the same thing, I will take this year minus this year profit. We will not take this year, because for if we take this year of profit, we have to take the capital employed in 2012, which we do not have it, right? Obviously, you can pull out this data and can do the calculation. So this is your profit side, and let us see what is your capital side. So you have to divide it by your capital that has gone inside the business. So that I can see it is here on the last year, this was your capital, and I will subtract this with the initial capital base that you had here. So this is your end-to-end calculation of your ROIC end-to-end basis. Now you see it is 17%, right? So whatever new amount of money that has gone, so I know what is the new amount of money that has gone. This is this money, right? This money has been put back in the business. Incremental is a portion of profit that has been invested in the business, and this amount of money you have seen it is earning a return of 17%. Now 15% is our mark, like above 15%, that is kind of the hurdle we should be considering. Above 15, that means it is good. Now that gives how much of capital the company has invested. Now let us also try to calculate another important factor that will give you a lot better understanding how much money the company is earning from its own profit. Initially, I have given you an example, like you started with 100 rupees, you have earned 20 rupees. Out of 20 rupees, you have taken 10 rupees as a dividend, and 10 rupees you have invested back in the business. So in this oversimplified calculation, you have taken 10 rupees from your 20 rupees earned profit. That means you have used half of the profit back in the business, right? So this ratio is also very, very important. We will see what is the implication of this ratio later. But before that, let us calculate what is this value of this. Now to do this, we will come to your cash flow statement of this company. Now we can see the value of your cash from operating activity. Now this is, as I said earlier, this is the number, this is the money the company has actually received. This is the actual money the company has received, operating activities, right? So we are going to deduct, or we are going to subtract the capital expenditure the company has done. Now, unfortunately, the Excel will not be able to capture what is the capex number. We have to get this number from here. So yeah. So initially, this is how you will find it. If you go here and click cash from investing activity, you will be able to see the first item is fixed asset purchase. So now make sure that you take the data from 2013 onwards. So we are going to copy this data and paste it here. Importantly, let's see how much of total money the company has received from this business. So we will make a total of the total money that it has earned in this entire time. So it is going to be summation of all this number. So this is the total money the company has got so far since 2013. Now we are going to add how much capex the company has made, or how much capital expenditure the company has done, or how much money the company has put back in their business. That we are going to find out. So let's put a sum. Do include all those number until March 2022. So if you're doing it, obviously the sign is going to be negative. Now, if you just see this number will give you a lot more understanding about what is the nature of the business and how much of money, what is the percentage amount of money the company is earning and reinvesting back in the business. So let us try to do the calculation. So this is the total money the company has got in over this year since 2013, and this is the expenditure the company has made back in their business. So now let us do a percentage calculation. So this divided by this, it simply gives you the number. That means Asian Paint since 2013, whatever amount of money it has earned through operating activities, it has put 34% of that money back in their business, and that money, this 34% of the money, the company is actually earning ROC of 17%. This is what it means. Now you see, when we started this, we show you the ROC number. If I just scroll a little bit and come to the ratio, see, when I started in 2013 and my number was 50%. The more and more money that I have put in, it has reduced my ROC. Now, why this ROC has been reduced? Because initially the business was profitable, but whatever new money that has been put in the business, it was not able to generate the proportionate amount of return. We have seen the return has been 17%. So if you do the math overall, 50% minus 17%, which is approximately equal to 30%. I hope that gives you a lot of clarity, but let us do one more calculation. Not one, we will do two more calculation. Let us do the same exercise for PI. Now let us remember this number. 34% of the money was invested back in the business for Asian Paint. We will do the same calculation for the company PI Industries. Now this is all for your calculation purpose. Please do not consider any of this as an investment advice or anything. We are just trying to show you how you can do the calculation by yourself so that you can take a much better informed decision. So now we have opened up the Excel spreadsheet of PI Industries. So we will repeat the same process. First, we will come to the balance sheet. After we come to the balance sheet, so first we will calculate what is the capital employed. So let us do the calculation. I hope you remember. So first we will do the summation: equity share capital plus reserve plus borrowing. And then we will subtract the cash equivalent we will do for the same year. We are doing it for 2013. So we will do for the same year, which is your cash and bank, which is 16.14 crores. So if we do it, this is your capital employed. Now, if we just drag this, I should be able to calculate what is the capital employed at the current year, which is March 2022. Then I will calculate what is my PAT or profit after tax. So let us quickly calculate profit after tax. Now we do not have to calculate, we have to just bring this information from your data sheet. And if we just open profit and loss statement for the 2013, we have to make sure we are doing the same year data. So 2013, from here we will be able to see net profit is this. So I'm just bringing up this data from that sheet to here. So after I do it, I have put out all this number. Now, before you do the calculation, first check the number. Initially, when the company at 2013, it had the capital base of 732. You can see the number here, 732. Today, the number is 5026. So you can see that it has increased drastically. So how much it has increased? If I divide by today's capital employed by the initial capital employed, you can see it has increased by almost 6.85 times. Now let's do the same exercise. In this year, the profit has been 843 crores, and back in 2013 the profit was around 97 crores. So obviously the profit has also increased. Now if we see the calculation, the profit has jumped up by 8.6 times and the capital base has also increased by 6.85 times. Right, now let us do the same calculation that we had done before, ROIC. So when we are doing the ROIC calculation, let us do for this year. So that means this year profit minus last year profit, right, divided by the capital base of your last year. Your last year capital base is this, minus the capital base of the preceding years. So this is, if you just put it in the percentage, you can get the number. Now, if you just simply drag this number, you should be able to get what is your ROIC as the time progress, right? So now if I do ROIC on 3-year rolling basis, let us see how this number shows up. Now when you're doing your own calculation, just check with this number. You should be getting something similar if you're following the steps correctly. So when you're doing it on the rolling basis, what I do, last 3 years I will make an average and accordingly we will proceed. So last 3 years, I think I made some mistakes. Average we will try to find out in this 3 years, right? So if we do it, it is 19%. And if we just simply drag until this point, we will be able to do until this point. Do not drag it here because you do not have the data for this year. At least you have the preceding 3 years of data. So now you still see some variation, 76%, 19%, 14%, 1%, but still it reduced the noise a little bit, right? Now this is on the 3-year basis. If you want to do the same calculation for ROIC on 5-year basis, 5-year rolling basis, you should be able to do the calculation also. Let us do the calculation. So for this case, we are going to take for 5 years data. 3 years last time we were doing. Now in this case, we are taking 5 years. So now this is how also you can do it. Now when you're doing it, you will be able to do until this point. Now when you see this number is much flatter than the earlier what you have done your calculation, right? So now you can see this is your 5 years rolling basis, whichever you want to consider. I think the best way to do the calculation is to see individual data and going to see the trend. If the business is going to have high gestation time, then it's better to do end to end point. So let us also try to do ROIC ROIC on end-to-end basis. So how to do that? Let us see. Today, what is the profit, and earlier how much profit I had. I had profit this. So it is important that we take in 2014, because then only we have the previous year capital base, which is 723. If you take the profit after tax for 2013, then you have to take the capital employed for the year of 2012. We do not have the data, that is why you are not taking. Now, if you are doing the calculation, you can bring up this number from the annual report. So that basis also you can do the calculation. I hope this is clear. When you're doing the end-to-end basis, you are taking this year profit, and also you're taking 2014's profit, and you are dividing up the capital. What is the capital you're dividing up with? You're dividing this capital minus the capital that you have here, right? So if you're doing it, this is your end to end point that you have it. What was your initial ROC? The initial ROC was 17.3 percentage, and let us also see the directional trend of this business. So if I come here, if I just see ROC of this business since 2011, we can see that we started from 30 and then it gradually came down to 17%. Now, for this 17% sudden down, there is a reason. The company has raised capital through a QIP, that is your capital, that is adding to the capital, but that QIP money has not been invested, so they're looking for acquisition, but still they have not found any acquisition. So the money that they have raised, that is getting added in your capital base, but that is not generating any return. That is why your ROC looks optically compressed. But anyway, this number is 17%, and you started with 30. So as you see, for until 2021, you see this mid range is around 28. So it is on the declining path, but still it is way above 15%. We have already done the calculation for your ROIC. The end-to-end basis, your ROIC number is 19%, right? Now let us also calculate how much money has gone back in the business. Now for Asian Paint, remember the number? It was 34% of their operating cash flow has put back on the business. Now for this, for PI Industries, also let's do the math. Let's come to the cash flow statement, and also we are going to take the calculation from March 2013. So if I go there and also come to cash from investing activity and check the first line item, which is your fixed capital purchased, we are going to take the value from 2013. So we are going to take this value. So we copy this, and then we are going to paste this value here. This is your capex, right? So, and now this is your capex number. So let us calculate over the time how much money this company has generated since 2013, right? This is the summation, simple summation that you can get. And let's also see the capex number. So let us also make a summation of your entire capex number, which is around 2835. We have to use a negative sign here. So far, the company has earned 3,872 crores, and they have done capex of 2,835. So let's do the percentage calculation of this divided by this. And if you're doing it, you see 73% of the money that they have earned since 2013 had been deployed back in the business. And this 73% of the money, if we want to see from here, how much additional money the company has put back in the business. This is the business. This is the total amount they have made capex. And coming to the balance sheet, we have done the calculation of your end-to-end ROIC. We can see 19%. So we can see 19%, whatever extra amount of money that the company has made the investment, that is earning at a rate of 18%. That is your ROIC calculation. I hope this is very, very clear. Let us try to do this calculation for Reliance Industries, right? Now, before we are doing it, let's see what is your ROC value. The ROC is 9.42%. That is for this year. Let us check the historical data. If we check the historical data, the ratio, if we see in 2011, we started from 12. As you see, as the time progressed, the ROC basically diminished for this big business. The directional trend is also clear. We started from 12. Right now we are at close to 9%. Now let us do the calculation. We'll follow the exact same step. So I am going to do the calculation a little bit faster. I hope you are now quite familiar with the calculation. So it has opened. So now let us do the same calculation. We'll go to the balance sheet, and after we go to the balance sheet, we will first calculate capital employed. How to do this? I hope this is very, very clear to you. So we are going to sum up your equity capital plus reserve plus your borrowing, subtract the cash. When you are going to do this, make sure you take the for the same year. So the cash that you had, that is for 2013. So 2013, here you see the cash for the company at the year of 2013 is this. So if we take it, we get the capital employed like this, and if we just simply drag, we are going to get the capital base for the company as the time progress. Right now, let us do a calculation how much money, just to get some idea how much capital has gone in this business. So the first divided by last, so that means almost 4.44 percentage of the time the capital has increased since 2013. Now let us bring the profit after tax for this company. Now remember, this is going to be as a part of your data. Now in this, we will be able to see this is a March 13 data. So this is your net profit. Let us pull up this value here. This is your net profit. As you, I think there's some bit of error. Now I think still this is fine. Let's check how much profit increment has happened since the last time. So you see the profit has also increased, but it is 2.57 percentage. But the capital employed has gone a lot more higher. The ratio is almost 4.44 percentage. Now we will do the calculation of your ROIC for the incremental basis for every year. So whenever we are doing the calculation, we are going to this profit minus this profit. I'm not going to explain because we have already done a couple of calculations. I think by this time you're quite comfortable checking up this number. So this minus this. So this is your ROC. Just convert it to your percentage basis, and then let's drag it. So now this is your ROIC on yearly basis. We'll do the same calculation 3-year rolling. That means for every 3 year, we are going to make an average. So average of this 3 years. So if we take it on the 3-year basis, it is 6 percentage, right? And we can calculate until this, because at this point you have last 3 years of data, right? Now rolling, you can do the same calculation for 5-year rolling basis. For doing that, you have to take that average of this number for not 3 years, in this case 5 years. So if you're taking this number for 5 years and if you are dragging it here, make sure that you take the right data from here, 1 2 3 4. So this is also correct. Now this is your 5 years rolling basis. You see the number are not fluctuating a lot. It's in the range of 5 to 7%. So you can see ROIC of this business is near around 5 to 7 percentage. Now we'll also do the same calculation that you had done before, that is ROIC on your end-to-end point. Right? So if we do this calculation, so that means we will take the profit of this year minus 2014 profit, which is here, and then we will divide it by the capital base of last year, which is here. Let's make sure that we put things in the right order, and from here we are going to take the capital employed. I think we have made some mistake here, so we'll do this calculation once again. So let us take this profit from here to here. This is the profit differences that we have from today's and 2014. We divide it by the capital base the company has, 2021 minus 2000. For end to end, this company is making ROIC 6 percentage, right? So you can understand, like ROIC, that means whatever new amount of money that has been deployed in the business, it's earning at a rate of 6 percentage, which is near around every return, right, over the last decade. Now let us also check how much money that has actually gone in the business, right? So earlier also you have done the calculation. Let us try to calculate all the operating profit money that it has got since 2000. Let us do this calculation once again. Sum of this point. Yes, sum of this. So that means this is the total amount of money that the Reliance Industries has earned since the year 2013. Now let us also calculate what is the capex number of this company. Now where we'll get this capex, we have to open this, then scroll down and come to your cash flow statement. In the cash flow statement, there is cash from investing activities. We will take 2013 data. Yeah, so this is the data. So make sure you take all the data, Control C, and then here you're going to do. Let us calculate what is the capex number also from here. Let's make a summation and let us take the number all the way since 2013. So if you check it, which number is more? This number is more, right? This number is more because the company has earned 548,000 crores and the company has spent in the capex or put back in the business even more money than that, right? How much more money? They have generated only this much amount of money, but they have put more and more capex, right? So what is this extra money coming from? This money, extra money can come from the new loan that it can take from bank, or it can actually issue QIP and can raise it. Whatever it has been, the capex has been funded by the external money. So let us see how much external money that they have put back in the business. If we subtract this minus this, that means this much money that they have actually taken a loan or taken from external sources. So they are taking from the external sources. You can understand in this case, they're taking from external sources. Obviously, there is going to be some amount of interest. Interest is not going to be less than 5% or 6%, right? And you see, in this case, the company is earning at a rate of 6% on the incremental money. So first of all, it is borrowing money. On the borrowed money, they are earning at a rate of 6%. So anyway, Reliance may be having a better plan to get more and more money in the long term. So probably that is how they're justifying their need for the capex. The main focus of this video was to help you learn how to check your ROCE and what is the directional trend of it and how you can calculate ROIC. Now, once you know that ROC is more than 15 and ROIC in the directional trend also, if you see on the end-to-end basis, if it is more than 15, it justified the amount of money the company is reinvesting back in the business. It is helping the company to generate more and more profit in the sustainable basis without taking any external support from the fund, in which case you need external support. That is, I hope that is also clear. So thank you for joining with us today to learn the things ROC and ROIC, and I hope it really helps in your investing journey. Thanks for watching. I'll see you in the next video. Until then, take care. Bye.